Have you ever looked at a market chart and just wished you had a roadmap? A way to see where the big, important trends are heading? Well, today, we're diving into exactly that. We're going to unpack Dow theory, one of the oldest and most reliable tools out there, and turn it into a practical guide for spotting major market trends and, crucially, how to know when they're about to reverse. So here's our game plan. First, we'll get into the mindset behind the theory. Then, we'll break down the 6 core rules that make it all work. After that, we get to the good stuff, how to actually see a trend on a chart. And we'll wrap it all up with a clear step-by-step guide to spotting the exact signals that tell you a trend is ending. Alright, let's jump right in. You know, it's so easy to look at the market's daily swings and think it's all just random chaotic noise. But over 100 years ago, Charles Dow had a different idea. He believed the market wasn't random at all. It was a giant collective heartbeat reflecting all our hopes, fears, and greed. Dow theory is basically his compass for navigating that chaos. And that's really the core of it all. Dow theory isn't just about lines on a chart. It's about understanding the human story behind those lines. Every tick up or down is the result of millions of decisions, all driven by emotion. Once you get that, everything else starts to make a lot more sense, okay? So if the market is a reflection of human psychology, how do we actually read it? Well, Dow didn't just leave us with a cool idea. He gave us a system. He laid out 6 core principles, and these are the foundational rules for the entire approach. Let's get into them. The first 3 principles are all about how the market moves. First, the idea that the market discounts everything. Basically, don't worry about the news. All known information is already baked into the price. Just study the price action itself. Second, think of the market like an ocean. It has a primary trend, which is the tide. That's what we care about. Then it has secondary trends, which are the waves, and minor trends, the little ripples. We're here to track the tide. And finally, every primary trend has 3 phases. First, the smart money gets in early, then the public jumps on board, and finally, the smart money starts to sell. Now, the next 3 principles are our reality check. It's not enough to just think you see a trend. Dow said you have to confirm it. So, number 4, different parts of the economy, like industrial stocks and transportation stocks, should be moving in the same direction. They need to tell the same story. Number 5, volume has to confirm the trend. If prices are going up, you want to see more and more people buying in. It shows conviction. And number 6 is my favorite. A trend is innocent until proven guilty. You assume the trend is going to continue until you get a crystal clear signal that says otherwise. So this all leads to a really important question. How do we actually see the primary trend on a chart? All this theory is great, but we need to see it in action. And Dow gave us a brilliantly simple way to do just that. A visual language that's now the bedrock of modern technical analysis. And here it is. It's actually super simple. An uptrend is just a series of higher peaks and higher valleys. The price goes up, pulls back a little, but not as far as before, and then pushes to an even higher peak. That's it. A downtrend is the exact opposite. A series of lower peaks and lower valleys. This simple structure, this pattern of highs and lows, is the absolute key to everything we're about to cover. And this is where the rubber meets the road. This is the payoff. Now that we know what a trend looks like, how do we use that exact structure to spot the moment it starts to break down? How do we identify a major reversal before it's too late? Let's walk through the steps. Okay, here's the 3-step process. Step 1. You've got your healthy established uptrend. Higher highs, higher lows, everything looks good. Step 2. You get a warning sign. The market rallies, but it fails to make a new higher high. Uh-oh, momentum is fading. Now, this isn't the sell signal just yet. It's just a yellow flag. Step 3 is the confirmation. The price then falls and breaks below the previous low point. That's the moment it creates a lower low. And that right there is the official signal that the uptrend structure has been broken. Now this is the million-dollar question for every single one of us, right? When the price starts to drop, is it just a healthy little pullback, a chance to buy the dip, or is it the beginning of a real painful bear market? This is the hardest part, but Dow's principles give us a fantastic framework to tell the difference. Let's put them head to head. The key difference is structure. A correction respects the uptrend, it makes a higher low. A reversal breaks the structure by making a lower low. The second clue is time. A correction is usually pretty quick, lasting a few weeks, maybe a few months. A reversal is the start of a whole new primary trend that could last for over a year. And finally, confirmation. A true reversal will be backed up by those other principles we talked about. You'll see the other major indexes turning down too, and you'll see a change in the volume patterns. So, as you can see, this framework is incredibly powerful for navigating those big market shifts, but let's be real, no tool is perfect. And to use Dow theory effectively, you absolutely have to understand its limitations. So here's the deal. Dow theory is what we call a lagging indicator. It doesn't get you out at the absolute top or in at the absolute bottom. It waits for confirmation. Why? Because the whole philosophy is about being right, not being first. It's designed to help you catch the big, juicy middle part of a major trend. This makes it a fantastic tool for long-term investors, but it's really not built for day trading or trying to scalp tiny moves. Which leaves us with one final thought. In today's world of AI, algorithms, and high-frequency trading, can a theory from the horse and buggy era really still be relevant? Well, here's the thing. The technology has changed, for sure, but the human emotions that drive the market, our fear and our greed, they haven't changed one bit. And that's why, even today, Dow's principles might just be the most reliable compass you have. Thanks for watching.